Good morning, everyone. Welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about the investment strategy of dividend growth investing, the upgrade in Home Depot stock, and Jamie Dimon's economic hurricane. But before we begin, as a reminder, this is a financial education presentation, should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Dividend growth investing is a popular investing strategy. Can you explain why and who it is best suited for?
Hey, good morning, Allison, and good morning, everyone. Welcome again from Hollywood, Florida, where we're on the last day of the investing conference. Pretty exciting. Michael Kitces, get to see him on stage here in a few minutes, and also Eli Manning and Archie Manning are here later today to talk some NIL and investing stuff. So we're really looking forward to that. So dividend growth investing. So let's back up just one step and think, when you think of investing strategy, you kind of need to become one with what you want to do and who you are and what you prefer. None of them are wrong. They all have pros and cons. Everything in life does. So you really want to think about what you want. And then once you figure that out, then you want to stick with that. The danger is hopping back and forth with strategies based on market conditions, because of the odds are your emotions get the better of you. Like right now, if you're a total return type person, which I am, that's why I invest. That's why I invest for almost all my clients, unless you're in retirement or we've specifically talked about it. Then I will reduce some risk there and focus a little more on income generation. But you want to avoid switching strategies, because when the market's down, you'll want to come out of total return mode and kind of go into dividend growth mode. And then when the market screams back higher, then the natural human emotion is to want to go back to total return. Well, generally you're 180 out from the phase, right? Because by the time all those signs are there, it's already happened, and then you're just backwards. So you're kind of crushing your overall return if you do that. So figure out what's right for you and pick a strategy, and then stay with that one for decades. Literally all of them will work if you stick with them through thick and thin. But specifically talking about dividend growth, the probably number one benefit of this is it does dampen the volatility. Things still get crushed when it's a sell everything type market, like you've seen with, I'll show you the 10 names that they kind of throw out there from Credit Suisse, IBM, Chevron, Coca-Cola, Emerson Electric. The only one I really have in the book here is NextEra Energy. So it's only got a 2.4% yield, but certainly a fantastic company. And I like the upside, right? I'm in it for total return. I'm not in it for this dividend. I call this it's some free cheese, if you will, along the way. But certainly I'm not in it for the dividend growth aspect of it. But certainly these are names that for the most part you've heard of. For the most part are big American names that are going to be there been around for decades and going to be around for decades, right? And they pay a nice dividend, and look at their PE ratio, it's nice and cheap. So from a dividend growth perspective, you do have a yield that's coming in. Some of that went away in 2020 with the pandemic, and then they for the most part, brought the dividends back. Some companies paid the dividends all the way through. But I wouldn't measure the reaction there, because that was a very unique time. But when you design your portfolio for dividend growth investing, you're largely stepping away from technology and going into names that pay a nice big dividend. To pay a nice big dividend, you kind of need to be at a mature situation with your company to be able to just pay out cash flow. If you were not in a mature situation, you'd be, instead of paying that cash flow out to your investors, you would be keeping that cash flow inside the company, reinvesting it in the company, and focusing on growth. So that's why it's very different from total return investing, and you certainly can't expect the same returns. So there's a couple reasons to do the dividend growth and be invested in these names. First of all, you look at them and it's not because of their upside, right? None of these is going to go screaming higher. It's just not going to happen. So you can't sit around and be mad because your friends are slapping high fives around the office of things that are doubling in a year or two, because that's just not going to happen. The However, if you are conservative and you don't like to say you have a $100,000 portfolio and you kind of really don't want it to see below 80,000, well, these names are only going to drop that 10 to 15%, even in a bear market. You're still going to lose like everybody else. There's no place to hide. But as it goes down, it's not going to go down as much as your Apple, Amazon, Google, or even other, huge American tech names. They're going to go down further. And we've seen that largely in the overall market with the tech names in a bear market, and everything else got close, but not quite, right? So really think about all of the seasons, right? So right now it may seem attractive, but when we have the decade of hyper growth and everybody's getting 20 plus returns and you're getting, 8% return plus another 3% in dividends, are you going to want to stick with this strategy? So if you are, that's great. Certainly, if you are in retirement and you're made, if you will, you're financially independent, you've got your 1, 2, 3, 4, 5 million, whatever you decide that is, and you've designed your portfolio for income. Now, certainly the income these names kick off is enough to provide you enough cash flow to live your life. That combined with Social Security, if you're claiming that already, or maybe a pension if you're fortunate, all of those things kind of package into your retirement. So if you're made financially, then yeah, pick up a dividend growth investing, and then just, the only thing you have to do is wake up in the morning and kind of ignore the fact that, CNBC is going to literally never talk about these names, right? They're only going to talk about the high flyers out there, and you're just not participating in that. So think about it. If you want to talk it through, I'm here for folks to figure out what's best for them. But once you do figure out what's best, you kind of want to lock that in and go with it, if that makes sense.
Next, Wells Fargo named Home Depot as a best idea for investing. Is ticker HD a buy, sell, or hold?
I couldn't agree more. Best idea. So you think of Home Depot, first of all, even before 2020, before the big pandemic, Home Depot is just a great American brand. And the retail space has been crushed. So are they retail? Well, of course they're retail, but there's so much more, right? They're Home Depot and Lowe's, you could argue back and forth. I'm not even going to take your argument. I think Home Depot is better, but that's an opinion. If you think it's Lowe's, fantastic. Don't care. Both of them are unique specialty retailers, and people tend to love their homes. People tend, now that the housing prices have gone up so much, a lot of people are willing to spend a little more on that house that's sitting there paying you. Maybe just raked in another couple $100,000 or $500,000 from home equity, just from buying a house way back in the day. So taking advantage of that situation is perfect to turn around and now spend money at a place like Home Depot or Lowe's. So when you look at the overall stock, we'll click on the name here. It's in similar ETFs with other retail names. So we'll go with the 1 year, and so you can see it's just been crushed. So it's down to right below $300. Getting ready to open today. You do get a 2.5% dividend out of the way, and then you look at the PE. Current 15, forward 18. So I mean, it's attractively priced, and it was up at 400 not too long ago. So really like the name. You can buy it all day long. It's a fantastic name out there, and really the same holds for Lowe's, even though I like Home Depot a little bit better.
Last, Jamie Dimon referred to the confluence of current events as an economic hurricane yesterday. What did he mean by that?
Yeah, that wasn't helpful, right? The market opened up, and then Jamie Dimon took to the airwaves and said economic hurricane. And you think the algorithms had a heyday with that? Well, they sure did. It came crashing down. Not super big, but over 1% there for a while. So what was he talking about specifically? He's talking about the quantitative tightening, which, if you don't understand this is, if it's easier to think back in 2020 when the bond market was falling. So the Fed hops in and they task BlackRock with buying up a bunch of bonds, right? To be able to bolster that bond market floor, because everything was being sold. Well, you have to undo that eventually. And that's what quantitative tightening is. It's just simply undoing the buying they did. So therefore there means there's a bunch of sellers out there in the bond market, and it's going to start this month. And there's big numbers, 95 billion a month. That's a big number. I don't care who you are. So that's going to have an overall effect of, they're basically reducing their balance sheet. So that's one headwind. And the other one, of course, is the Ukraine-Russia situation, which we just don't know. There was a pretty ugly headline this morning about Russia taking over a city. I didn't read the article, but certainly I thought this thing was going to go on weeks. It's on into months now with no real end in sight. So if this drags on through, say, the elections or through the end of the year, it's going to continue to be a problem. Why is it a problem? Well, our exposure to Europe and Russia, right? So this continues to wear on everybody, even though it's not obviously being fought on our soil. It continues to wear on us economically. So that, combined with inflation, which isn't even mentioned here, are certainly headwinds to the overall economy and in turn the overall market. We talked yesterday about some reasons. There's some tailwinds coming up though, with it potentially through the elections. So anyhow, overall, I'm not sure he meant to hit the markets hard with his economic hurricane comment, but he certainly did. But this morning, when you look at the markets overall, it appears that they've shrugged that off and we're back in the green this morning. So we'll see how things go today.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.